The profits that are going to be earned by both the office are going to be taken into the taxable profit. For this purpose of the standard, that is AS12, the tax base of the asset is the amount that will be deductible. The excess shall be recognized as an asset. Good morning and welcome to the first session in Unit 4, where we are going to talk about a very interesting topic in IFRS, and that is called as accounting for revenue and expenses under the income taxes factor. So this is a very important thing where we are going to speak about the accounting standard 12. So let's go further and try to understand why it is important for us to account for the income tax. The objective of the standard is to prescribe the factor called as the accounting treatment for income. Basically what we are trying to understand here is that we are trying to understand how income tax has to be treated as a part of the accounting standard. Now, the principal issue in accounting, when I like to talk about the principal issues here, I would also like to say that the principal issues is more from the income taxes, is how to account for the current and the future tax consequences. We all know that over a period of time, it is always quite important for the company to assess the income for today as well as start looking in for the future. So today, whatever I am earning, I am going to pay an income tax for it, followed by the future where I would be paying the income tax also. So I need to understand what are the consequences from the tax standpoint so that I know how exactly I'm able to go further in terms of assessing my income and paying my income tax altogether. The future recovery settlement of carrying amount of assets, liabilities that are recognized in an entity's balance sheet. So the way you are going to take it forward in terms of assessing the assets as well as the liability factors are going to be looked in from the balance sheet standpoint. The other thing is that the transactions and other events of the current period that are recognized in an entity's financial statements, because that is also very important here. We need to understand what are all the transactions and other events of the current period that are recognized in an entity factor, because there might be certain times that you might see that in the current factor, we need to understand that there are certain transactions going on, there are certain business affairs that are going on which needs to be entered, which also need to be understood from the financial standpoint. So all these things have to be recorded in the balance sheet. Moving further, the scope of this entire standard, the scope of this entire factor is all about the standard shall be applied in accounting for income taxes, which is very important. For the purpose of this standard, the income taxes include all domestic and foreign taxes. So all the factors of both national and international are going to be taken here, are based on the taxable profit. So if I have an office in India and if I have an office in abroad, the profits that are going to be earned by both the office are going to be taken into the taxable profit area altogether. Income taxes also include taxes, that is withholding, which are payable by a subsidiary, associate, a joint venture or any other distributions reporting to the entry. So what happens here is that it's not only the parent company that we are talking about in terms of income tax. We are also trying to talk about any associate, subsidiaries, joint ventures, franchise or any kind of arrangement which are reporting directly into the entity. Even they are a part of the taxable income cycle and they have to report as in how much profit, what are all they have been able to do in the last year. So all those things will be taken into account and then the income tax will be calculated. Moving further, the definition for this purpose of the standard, that is AS12, the income tax include all domestic and foreign taxes which are based on the taxable FAT. So there we are going in, which we are going to include about the withholding taxes, the taxes which are already held, which are payable by the subsidiaries and by the entities. So the definition here is even more emphasizing, which it tries to say that whatever amount you have held back, whatever amount is going to be earned, and whatever amount that is going to be paid, that is which you have kept in mind to pay it back, all those definitions will be included, all those factors will be included at any given point of time. So that is why this becomes a very, very interesting factor. That's why it becomes a very important destination altogether to understand. Moving further, the tax base. Now, what is the tax base? The tax base of the asset is the amount that will be deductible. So this is going to be deductible for tax purposes against any economic benefits that it flows into an entity when it recovers the carrying amount of the asset. So all these factors are going to be recoverable, that they are a very, very important factor altogether. And if those economic benefits will not be taxable, then the tax base of the asset is equal to its carrying amount. So automatically the tax base benefits will become into the carrying amount altogether. So these are all the factors that we need to understand as how it comes into picture. What are all the different governing things that we have to understand? Now, when you start seeing here, you will start understanding that at some point of time, the tax base is actually being used for, from where the source is coming in. So what is the base at which? And when you see the asset, where it is located and from where it is being used, the tax base becomes the source factor from which the tax is being used for the future economic, that is, the income is used for the future economic base. And if those economic benefits are not taxable, the tax base of the asset is equal to its carrying amount. So whatever carrying amount comes in for that particular tax base, for that particular zone altogether, that has to be recorded at that given point of time, followed by the recognition of the current tax liability and current tax asset. Now look into the factor. One side we are going to talk about liabilities, the other side the asset. Current tax for the current and the prior periods to the extent of unpaid, not to the extent of paid, only to the extent of unpaid will be recognized as liability. Why? Because I have not paid it. This amount has to be paid back. So that is where it becomes a liability factor. If the amount is paid in the current scenario, it's paid in respect of the current and prior period, exceeds due to the amount due to that particular period, the excess shall be recognized as an asset. So the excess value will be recognized as an asset altogether. So all these factors will be coming into picture in terms of understanding the value. So current asset, when I talk about the current tax liability, it is only to the extent which I have not paid. Moment I pay that tax, I am over with the liability. But then suppose in respect I have paid it in advance and I am expecting a return going to come back, that becomes a tax asset for me. So even before that particular period, I go further and I pay my tax and I have paid it in excess. So the returns that I'm going to get back, the money which I'm going to get back will become a current tax asset for me. Now, moving further, a deferred tax liability shall be recognized for all temporary differences except to the extent that the deferred tax liability arises from. From where does it arise? The initial recognition of goodwill, which is now coming into picture. The initial recognition of goodwill of an asset or liability in a transaction, which is not a business combination at any given point at the time of transaction, affects neither accounting profit or taxable profit, which is also very, very important for us to understand. Now, if you look here, moment I use the word deferred tax, that means to say that I have just postponed the tax for some more time period. I have just gone ahead and said that it is not going to happen right now. Probably I'm just going to pay it sometime. Except for the factor, now the initial recognition of the goodwill. At that point, the goodwill factor, that's one criteria which we need to understand. The initial recognition of an asset or liability which is there, which is not a combination of the business and at the time of transaction does not affect the accounting tax period altogether. Now, deductible temporary difference. Please understand the word clearly. Deductible temporary difference. A deferred tax asset shall be recognized for all deductible temporary differences to the extent that it is probable that taxable profit will be against which the deductible temporary difference can be utilized, unless the deferred tax asset arise from the initial recognition of asset and the transaction value. So what we will do is that whenever we are using this deductible, that is the deferred tax factor, it will be recognized as a deductible temporary. So against everything we will deduct this factor. We will keep this in mind. Yes, this much amount of money I have to pay it as tax. So I'm going to keep it as a deductible tax factor to the extent that it is probable that taxable profit is probable and it is going to be deductible against that temporary difference in terms of utilization, unless and until the deferred tax arises from the initial recognition of the liability or asset. Until then, this will be kept as a deductible buffer altogether. Why? Because we have to recognize the value like that. Followed by the deductible temporary difference, or the other factor that we have to understand, it is not a business combination. So at any given point of time, it is not a business combination and it is not being recognized during the accounting period, that is on the initial effort, nor the taxable profit. So it is not coming both into the picture at any given point of time. With this, I come to the end of this session. I hope and believe that the session was of a great help and resource to you. In the upcoming sessions, we are going to speak about the IFRS accounting standards in terms of employee benefits, which is becoming a very, very big way in terms of modern accounting in the corporate world today. But until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me today on this session.